different sort of small workshops, and people like Sharif Suki are sitting in the back, okay? He's not doing that for headlines or to get plaudits. He's doing it because he thinks by hanging out and thinking hard, I can get a competitive advantage on others. That's how you do well. You think that's really good.
Ladies and gentlemen, good morning. My name is Jonathan Elkind, and I am a fellow and senior research scholar at the Center on Global Energy Policy. And thank you very much for joining us this morning for what promises to be a fascinating program. We live in a time when change is coming thick and fast to the energy sector. New technologies, new policy concerns, new market structures, and more. Now, change has always been a part of our energy economy, but given the scale and pace of change unfolding today, one could be forgiven for trotting out the old adage, variously attributed to Niels Bohr, Yogi Berra, and others, that it is difficult to make predictions, especially about the future. In fact, we have no alternative but to attempt to understand what the future will look like or might look like under different circumstances. We have to understand how to enable the provision of reliable, secure, and environmentally sustainable energy services. We must understand how markets will serve the billion-plus inhabitants of our globe who lack access to modern energy, and the countless more who aspire to raise themselves into the emerging middle class, which appears certain to translate into significant new demand. Last but not least, in a time when geopolitics has reemerged as a core consideration, we need to understand what trade wars and anti-globalist trends portend for everything from employment levels to investment requirements. How fast can our global energy economy change? How fast is it likely to change? What features can make it change? In short, our session today with Spencer Dale, BP's Group Chief Economist, is extraordinarily timely. It's also noteworthy that BP very consciously elects to use its annual outlook, the subject of our presentation and discussion today, as an instrument by which we can consider and weigh alternative visions of the energy future. BP has emphasized that they welcome the opportunity that today's session provides to discuss and even debate whether they've gotten their sums right or not. And from this, we can all end up better informed about where we're heading. So let me take a minute and introduce our featured speaker and our two colleagues who will serve for the panel discussion that will follow Spencer Dale's presentation. Spencer Dale is BP's Group Chief Economist, as I said earlier. He's therefore responsible for advising BP's board and executive team and manages BP's global economics team, providing economic input into the firm's commercial decisions. Spencer joined BP in October of 2014. Before joining BP, he was Executive Director for Financial Stability at the Bank of England and a member of the Financial Policy Committee. He had a long career with the Bank of England, having served there since university studies. He also served for a time, from 2006 to 2008, as a senior advisor to the U.S. Federal Reserve Board. He was educated at the University of Wales, gaining a Bachelor of Science in Economics, and at the University of Warwick with a Master of Science in Economics. Excuse me. Shayle Kann, who is at the far right, viewed from your perspective, is a non-resident fellow at the Center on Global Energy Policy, and in his full-time capacity, he is the Senior Vice President of Research and Strategy at Energy Impact Partners. Previously, Shayle served as Senior Vice President at Green Tech Media and Head of GTM Research, where he led a team of 25 analysts tracking and forecasting the evolution of the electricity sector. Shayle is a prominent writer and speaker on energy issues. He is the co-host of the popular energy podcast, The Interchange, which if you have not listened to, I'd certainly recommend. He graduated cum laude, Phi Beta Kappa from Pomona College. Last but not least, Katherine Spector is a research scholar also at the Center on Global Energy Policy. She's an experienced energy market analyst, having spent the past 15 years producing thought-leading research at major banks. She initiated commodities strategy for the sales and trading desk at CIBC World Markets, based in New York. Prior to that role, she was with JP Morgan, Deutsche Bank, and Energy Intelligence Group. Katherine was acknowledged by Bloomberg in 2013 as the most accurate forecaster of benchmark WTI prices over a 2-year span, which proves that she's got a lot more practical skills than your moderator this morning. She graduated with honors in political science from Yale University, where she focused on patterns of rent distribution in petrostates and implications for democratization. So we have a great program for you today. We will start by inviting Spencer Dale to come to the podium and give us an overview of the BP Energy Outlook. Spencer, thank you.
Thank you very much, Jonathan. Before I start, there are many seats at the front, so if you're standing, please don't stand for the next half an hour, otherwise I'm going to feel really guilty. So there are seats at the front. If there's not a seat at the front, at least one of them is taken up with BP's press officer. He can stand at the back, no problem. So please do come down and sit down if you'd like to do so. Thank you all for sparing the time to come out for the presentation today. I say this every time I speak at the centre, but it's true. I think what Jason Bordoff and Jonathan and others are building at Columbia in terms of the Centre for Global Economic Policy is one of the smartest centres around for thinking about global energy. And since joining BP, I've been sort of trying to be closely affiliated with the centre, and I think you're all very lucky to have it on your doorsteps. I think they're doing some of the most interesting work and convening some of the most interesting meetings. So it's a real honour for me, again, to be part of the centre. So thank you very much, Jonathan, for the invitation to come back today. For those of you who are not familiar with BP's Energy Outlook, we produce this document every year trying to think about the forces shaping global energy markets over the next 20 years. And we do this outlook, the key reason we produce this outlook is to help our own thinking and our own strategy. By far and away, my most interesting responsibility at BP is I'm part of a team of people that are responsible for shaping BP's strategy over the long term, and this outlook feeds into that process. Now, to be clear, we know we can't predict the future, okay? We know any forecast will be wrong. The value of an outlook like this isn't to try and predict the future, then we might as well just go home if that's the case. It's to try to better understand the uncertainty you face. And you do that by asking a whole series of what-if statements. What if electric cars grew massively? What if China slowed down? What if single-use plastics were banned? How would that affect the global market for oil or for global energy? And by doing that, you start to get a better idea of the shape of the sort of the span of uncertainty you face over the next 15, 20 years. And a rational thing for a company like BP is not to say, well, let's just predict what we think is going to happen. It's to say, let's do a strategy in a portfolio of assets that do quite well across a whole range of outcomes. And that's how we use that document. And I promise you that the document that you'll see you've got in the back and you have in front of you is exactly the same one as we share with our executive team and the board. You may think it's wrong, that's absolutely fine, but it's not some complicated conspiracy theory. This is what we think is useful, and so that's what we're using. Why publish it then, if it's so useful? One is, it provides the evidence base for our strategy. If I'm standing up and saying, we think electric cars are going to grow rapidly and we're still investing in oil, at least some people will go, well, how's that then? How does that work? And we need to explain some of our analysis. So part of this is, it's the evidence base that we share with shareholders to explain why our strategy is what it is. But it's also a way of testing our thinking. If I stand up and say, we think electric cars are going to grow really rapidly and we're still investing in oil, and that doesn't make sense, trust me, as I go around the world, people will be more than happy to stand up and say, Spencer, that doesn't make any sense. And that's a really good way of testing your thinking, making sure you don't sort of succumb to a big groupthink. So please, during the question and answer session, If I've said something which sounds a bit wrong, chances are it is. Feel free to interrupt and correct me. That way I will go back and carry on learning from this process. So we build a whole range of alternative scenarios when thinking about the energy outlook. And then we look at these different scenarios through three different lenses, if you like, onto the energy system. So we first of all say, how is that energy used ultimately in the economy? So how is energy used within industry, within buildings, and within transportation? We then say, where in the world is that energy being produced and consumed? So the where question. And then we finally ask, what fuels and what energies are rising over time to meet energy demand? So, if you like, three different windows onto the same changing energy landscape. There's still some seats at the front here as well. In this scenario here, this scenario I'm going to look at here is called the evolving transition scenario, and I'll explain to you the different scenarios as we go through. The evolving transition scenario is a scenario which tries to get a sense of the path, the broad path the energy system will evolve along if technology, government policies and preferences continue to evolve in a speed and manner consistent with the recent past. They won't. And the whole fun of this is saying how may they differ and exploring that. But this just gives us a sense about the path they're on absent a shock. And in that world, this shows you global energy demand. So it's the same energy demand that's just viewed through those three different windows. And energy demand in this scenario is increasing by around 30% out to 2040. In terms of what drives that growth in energy demand, some of it is coming from population growth. So some of the growth in energy demand is coming from population. But by far and away, more importantly, is increases in global prosperity. So we have something like 2.5 billion people, that's around a third of the world's population today, are likely to move from low to middle incomes over the next 20 years. It's that increasing prosperity which drives global economic growth over the next 20 years. And it's that increasing prosperity which also drives increasing energy growth. The extent to which energy demand needs to rise is then offset by very significant increases in energy efficiency as the world gets better and better at producing more with less energy. So in this evolving transition scenario, global GDP more than doubles, but energy demand only increases by about a third, and the difference between those two is energy efficiency. And if you like, if you see different profiles for energy demand coming out from different outlooks or different projections, have this chart in mind, because ultimately there's only really two big unknowns here which are going to drive energy demand over the next 20 years. Is, do we see this growth in global prosperity, and how much of it is offset by energy efficiency? They are the two big determinants of energy demand over the next 20 years. And in some sense, having this simple chart in your mind allows you to interrogate. If somebody's got a very different profile, it must be one of those two blocks. Either the orange or the blue block is different to what we think about. If we go back and say, well, where in the world is that energy demand coming from? So we look through that middle window. All of the growth in energy demand is coming from the developing world, led by China in the dark blue here and India in light blue. It's the developing world in developing Asia, which is where that's increasing prosperity is happening most in a most pronounced way. Energy demand within the OECD, which is in the green bar, is essentially flat. So in this evolving transition scenario, energy consumption in the US is essentially flat over the next 20 years. In the EU, we have it declining over the next 20 years. So for a company like BP, where are our markets? Where's the growth markets? It's not in the developed world. All of it's in the developing world, particularly in developing Asia. That's where that growth in energy demand is coming from. In terms of that third window, in terms of the fuels, which fuels are growing to meet that increasing demand of around 30%? We think renewable energy, shown in the orange bar here, is likely to be by far and away the fastest growing source of energy. In BP, when we talk about renewable energy, we separate out hydropower because that's a sort of more mature technology and so has a slower growth rate. So renewables here are essentially wind, solar and biofuels.
They account for around 4% of primary energy today, rising in this evolving transition scenario to about 15%. Remember that 15% number, and I'll come back to that in a moment. That provides around half of the growth in primary energy over the next 20 years, so around half coming from renewable energy. Natural gas, in red here, is also growing robustly. You can see on the chart of shares, it's overtaking coal in the mid-2020s to be the second most significant source of energy, converging on oil by 2040. Renewables and natural gas together provide around 85% of the growth in primary energy out to 2040 in this scenario. So 85% of the growth in energy coming from a combination of either clean or cleaner energy in terms of renewables and natural gas. Oil demand continues to grow over the next 10 years or so of the outlook, and total grows by about 10 million barrels a day, and then is gradually plateauing off in the 2030s. And finally, in terms of coal, which is that black line there, coal consumption share is declining. Overall, in levels terms, coal consumption, global coal consumption in this scenario is essentially flat, with falls in the developed world of the OECD and China offset by increasing coal consumption in India and other parts of Southeast Asia. And those two things pretty much balanced out, so you've got a flat coal consumption. That's a very, very rapid, quick run-through in terms of the headlines. I wanted to sort of structure the presentation around 5 questions. So, how much more energy does the world need? What do and don't we know about future oil demand? Picking up on a point that, Jonathan was making, what might happen if the trade disputes escalate? Just how quickly can renewables grow? Will they keep on surprising us? And finally, sort of the shift to a low-carbon energy system, what more needs to be done? So I said to Jonathan before I started, I said, Jonathan, I don't think I've got time to go through all 5 of these questions. Which one shall I not do? And I said, I think I may miss out oil. And he said, well, the people quite they're interested in oil. And I said, well, should I go on for 35 minutes? He said, well, no, really, you really shouldn't do that. So Jonathan was no help whatsoever in nailing this. So I'm going to make an executive decision. I'm going to miss out that middle one because I've been in this room before and the conversation is good. So I'm going to miss out the oil one, but I'm more than happy to get back to oil if we have time at the end. So first of all, this question about how much more energy does the world need? In BP, we frame the sort of challenge facing the energy system over the next 20 years in terms of the dual challenge facing the energy system. So we define the dual challenge facing the energy system as that the world needs more energy and less carbon. Now, the less carbon component of the dual challenge, I think most people are familiar with. Climate science is real. We need a very substantial fall in carbon emissions over the next 20 years to stop those significant impacts of global warming affecting our daily lives. That's the less carbon bit. The more energy component, I think, is perhaps a little less understood. So that story I just told you in terms of that evolving transition scenario, all of the growth in energy demand coming from the developing world as people move from low to middle income. This chart looks at the relationship between energy consumption on the horizontal axis in countries around the world. This is at a point in time in 2017. Each of these green dots are a country and looks at the relationship between energy consumption and human development as measured by the United Nations Human Development Index. And as you would expect, there's a positive correlation. Increases in energy consumption tend to be correlated with improvements in human development. And that relationship is particularly pronounced up to levels of energy consumption of about 100 gigajoules. So for periods of up to 100 gigajoules, increases in energy consumption tend to be associated with very significant increases in human development. A gigajoule is not a very helpful number to have in your head because what is 100 gigajoules equal to? Very roughly today, America, a typical American person consumes about 280 gigajoules. Somebody in India, about 25 gigajoules. So that gives you an idea. So this relationship very pronounced up to a level of about 100 gigajoules. What is surprising is around 80% of the world's population today live in countries where average energy consumption is less than 100 gigajoules. So 80% of the world's population live in countries where increases in energy consumption tend to be very significantly associated with very significant increases in human development. In that evolving transition scenario, that share of the countries living in that low energy region declines from about 80% to 2/3. So still by 2040, 2/3 of the world's population living in countries where increase in energy consumption tend to be associated with improvements in human development. The world needs more energy if we're going to continue to grow and prosper. In the Energy Outlook, we do an alternative scenario and say, suppose we, as a society, we just say that's not good enough. Suppose we want to reduce that share of people living in that low energy region to one-third by 2040. In that world, energy, other things equal, energy would need to rise not by 1/3, but by about 65% by 2040. The world needs more energy to continue to grow and prosper. And that's the sort of the underlying point of the dual challenge. I sometimes frame this, I was just having a breakfast, so I was explaining it. I often sit in meetings around the world where there's oil and gas companies, there's government officials, there's major financial institutions, and there's major advocates from climate groups making the case for the need to reduce carbon emissions. All of those arguments those climate advocates are making are real, they're urgent, and they're vital to be made. The problem is, there's typically in the room is not development experts making the importance for the need for more energy. And as a result, this conversation is getting a bit skewed because the need for less carbon is being made and vitally it's important to be made, but we're not having the same people making the argument for more energy. And this is what the dual challenge is supposed to be about. There's not a simple magic wand. There's not a solution in the book. I say, oh, turn to page 74 and we've solved it. There's no, I'm not suggesting that. The point here is any long-term viable, sustainable path for the energy system needs to engage with both these components. And that's what the nature of the dual challenge is about. Now, at this point, close your eyes, or you can get the flicker thing as I'm going to go through the energy oil demand story. I wanted, and I'll come back if I do have time, but I didn't want to rush this stuff. The second point, which is a topical sort of thing, was we wanted to ask ourselves, what might be the impact of the recent trade disputes on the global energy system if those trade disputes persisted and escalated? Now, to emphasize a point up front here, the idea here isn't to try and model the impact of any particular trade dispute. It was to look at the generic impact of trade disputes on the global energy system. And to do that, we considered we assumed that a trade dispute would have two sort of generic effects. First, if those trade disputes led to a world where there was reduced openness and reduced trade, that would tend to reduce global economic growth over time, trend global economic growth. And this is a fairly standard result from the economics literature, where if you're in a world with less openness and less trade, economic advances and productivity advances in one part of the world transfer to other parts of the world more slowly, and that tends to reduce global economic growth over time. So we allow for that first point. The second point was, say, in this world where energy, when trade disputes are increasing, people who import energy may become increasingly concerned about the energy security of those imported energies. And so they may end up attaching a small risk premium to imported energy relative to domestically produced energy. And we assume a risk premium of around 10%. Now, the 10% is somewhat arbitrary. There's some pseudoscience to that, but it's a sort of somewhat arbitrary number, so you can pick a different number. The way to think about this, if I'm a country importing oil today, and suppose the oil price was about $60, I'd be willing to pay up to $66 for domestically produced oil or an oil equivalent because of the extra security that would provide for me relative to a world where I was importing that. What's striking is the two assumptions we made here are pretty small, but the impact on the energy system were quite profound. So overall, global GDP was about 6% lower in 2040 relative to evolving transition scenario. So relative to a world where this wasn't here, it's about 6% lower, and energy demand was about 4% lower. Now, some of you at this point said, I thought Spencer just said these were big numbers, 4%, that doesn't sound that big a deal. 4% reduction in energy demand in 2040 is roughly equivalent to the entire energy consumption of India today. So it's just taking like India out of the energy demand equation. I think that feels to me a fairly sizable number. The other point here is that energy security component, that risk premium, that desire to shift away from imported energy into domestically produced energy means the fall in energy is concentrated on on traded energy, particularly oil and gas, shown in the green is oil and the red is gas. So this fall in energy demand is being concentrated on traded energy because of this home bias. And this combination of lower overall energy demand, together with this home bias to domestically produced energy, means you see some of the major energy importers in the world, pattern of energy demand shifts quite significantly. So for China, for example, their imports of oil and gas in 2040 are around 20% lower in this scenario relative to the evolving transition scenario, because they need less energy, and moreover, they're moving away from oil and gas, and to the extent they can, using instead domestically produced renewable energy, but also domestically produced coal. The corollary of that is the major oil and gas exporters of the world are the ones who are most severely hit by this trade disputes. The major oil and gas exporters of the world, particularly, are Russia and the US. So in this scenario, the US exports of oil and gas by 2040 are 2/3 lower than in a scenario where they're not affected, where we didn't have these trade disputes. The biggest losers from a trade dispute, if you're going to have these energy security components, or just as a matter of logic, are the world's major oil and gas exporters, of which the US is one. In that context, I'm always struck by this sort of fact that the share of oil in the global energy system peaked in 1973, the year of the oil embargo, and from then on has never got back to that same share. And what happened at that point of the oil embargo? People worried about energy security and started to search for other fuels which they could compensate and move away to leave them less exposed to those energy security risks. So the lesson from history is energy security risk can have persistent scarring effects. And that same lesson is brought through in terms of this less globalization scenario. Fourth question, just how quickly could renewable energy grow? As I was saying, in that evolving transition scenario, renewable energy by far and away the quickest source of energy growth, accounting for around half of the growth of primary energy and around 2/3 of power generation. So you can see in this chart on the right, this growth means that by 2040, renewables overtake coal as a major source of power generation globally around the world. Just to give you, what I wanted to do is put in context this growth in renewables in a sort of historical context. So some of you may have seen a chart like this before. If you haven't, it's a very cool chart, but you just need to spend a minute to get your head around how the chart works. Once you get your head around it, it's a cool chart. So the way this chart works is the clock on this chart starts at the point when each one of these fuels accounted for 1% of world energy, and then it looks how that share of world energy changed over the next 50 years. So for oil, in green, the chart starts in 1877. That's when oil provided 1% of world energy. And then it looks how that share built up from 1% over the next 50 years. For nuclear, its share started in 1974. No coincidence there, 1 year after the oil embargoes, we moved away from oil. And we haven't yet got to 50 years for nuclear. And the point to take from this chart, it takes an awful long time, multiple decades, for energies to penetrate new energies to penetrate the energy system. It took, if we just take 10% as a sort of rough metric, it took 45 years for oil to go from 1% of world energy to 10% of world energy. Natural gas in red didn't make 10% even after 50 years. Energy transitions take multiple decades. And the key reason for that process is the energy system is a highly capital-intensive system. Cars last for 10, 15 years. Power stations last for 20, 30, 40 years. Unless you're going to scrap those productive assets, they act as an actual brake on the pace at which new energies can penetrate the energy system. So what about renewables? Renewables here in orange. The clock for renewables started just over 10 years ago in 2006. And so far, you can see it's pretty much followed the same path as nuclear over the next 10 years. In the evolving transition scenario, remember I told you it got to about 15%? Remember I said keep that 15% number in your mind? So what that implies, the path that implies for renewable energy is this one here. So in that evolving transition scenario, we expect the technology gains from renewables to keep on continuing. So we expect renewables to grow more quickly than any fuel ever seen in history. So am I optimistic on renewables? Absolutely. More quickly than any fuel ever seen in history, even in that evolving transition scenario, the one where the path we're on at the moment. But as I'll come on to show you, that evolving transition scenario is nowhere near close enough to meeting those Paris climate goals. And I'm going to come and show you in a minute our rapid transition scenario, which does achieve that goal. But to get on a path consistent with meeting Paris in that rapid transition scenario, the growth of renewables is literally off the charts. Okay, so it literally is off the charts. I had to rescale the chart. It wouldn't fit on this chart, so I literally have to rescale this chart in order to for renewables to achieve anything like that. So in that scenario, renewables getting to close to 30% by 2040. What message do I take from that? Not that this is impossible, but one is, if we're going to get anywhere close to a pathway consistent with Paris, the speed of transition and change in the energy system will have to be truly unprecedented. And we should have that in our minds when we think about our businesses and the pace of change we will need to see. And secondly, that if we are going to get anything close to that rapid transition scenario, we will need to see a whole sort of comprehensive set of policies. Which takes me to my last thing, and I'll bring it in 2 or 3 minutes, Jonathan. So a low-carbon energy system, what more needs to be done to achieve that carbon system? So just the chart on the left here shows you the evolving transition scenario and shows you carbon emissions implied by that, by that evolving transition scenario. And you can see carbon emissions in that scenario continue to drift up. They're growing less rapidly in the past. That's the good news. The bad news, though, is to get anywhere close to a Paris-consistent pathway, we don't need carbon emissions growing less quickly. We need them to be falling very substantially. So this is not consistent with meeting Paris. So if we look at the chart on the right, that just sort of talks about which sectors are accounting for those carbon emissions. And a point to take away here is the most significant sector in terms of carbon emissions, even in 2040, is the power sector. So even with that unprecedented growth in carbon emissions, in renewables, more quickly than any fuel ever seen in history, the power sector still accounting for around 40% of carbon emissions in 2040. In the rapid transition scenario, we try to build a scenario which is consistent with meeting the Paris climate goals, and we try and think about the policy measures that may need to be achieved in that. The book goes through this in really quite a lot of detail, because what we try and do is we think about 3 sort of different sectors of the world. So we think about the power sector, the transportation sector, and also industry and buildings as one. And we consider a whole range of policy measures that can be applied to those sectors, where we try and keep sort of the level of effort and implied cost of those measures across those sectors pretty consistently. One message to take from that, there's no silver bullet. We can't just make one policy measure and it all solves this for us. We need a whole slew of different policy measures. A significant role for carbon prices in those measures, and I can talk more particularly in the power and industrial sector, but also a role for sort of target regulatory measures as well. If I now look at what the profile, if I can build in now our rapid transition scenario in the orange line here, we have carbon emissions falling by around 45%. That blue swathe is a swathe of external projections which claim to be consistent with meeting the Paris climate goals. This is by no means a comprehensive set of all measures. If I could get an even bigger set, I'd have an even bigger, wider range. And so one message to take from this is there's no unique path to Paris. There are many, many different paths to Paris, and these scenarios are just a sample of those paths. But we're pretty much in the middle, so you can think of the orange line as being sort of consistent with Paris. So the question here is, how do I get off that green line onto the orange? What does most work getting off of green onto the orange? In terms of sectors, it's the power sector which is accounting for around 2/3 of that movement off of the green onto orange. So in terms of where the low-hanging fruit is in terms of carbon emissions, it's the power sector where you get most bang for your buck. In part, that just reflects the fact it's the single biggest source of carbon emissions. But it also reflects the fact it's the power sector where fuels compete side by side, literally by hour. So small shifts in relative prices gives you a big bang. That's where you get the most bang for your buck. In contrast, the transportation sector, where we literally have thrown a whole range of measures. You can look in the book. There's a lot going on in terms of the transportation sector. Hardly does anything. So a message from this outlook is in terms of where's the low-hanging fruit where policy should be targeted on over the next 20 years, it's not the transportation sector. It's the power sector where we should start, go second and go third, and after that it's buildings and industry. Very quickly, what does the energy system look like in that world? So that here I'm looking at the energy system in the rapid transition scenario. Energy demand in that scenario increases by about 20%. So again, even in that scenario with huge gains in energy efficiency, the world needs more energy, even in that rapid transition scenario. The growth of renewables, that off-the-chart growth in renewables, accounts for more than the entire growth in primary energy, with its share getting to 30% by 2040. But again, as a matter of logic, if renewables are providing 30% of the world's energy in 2040, it implies that something else has to provide the other 70%. Here, oil and gas together account for around a half of the world's energy in 2040. And the punchline from that bit of the analysis I moved out, for oil to get anywhere close to just having this role in the rapid transition scenario will take many trillions and trillions of dollars of investment in oil and new gas over the next 20 years just to be able to provide the amount of oil and gas needed in this rapid transition scenario. I have some more analysis which goes on and talks about beyond 2040, but I'm going to run out of time, so I will stop there. And then we should hand over and we can get into some of this during the discussion. Big message here is the world is going through a transition. The nature of that transition is hugely uncertain, so we need to try and pick a portfolio and strategy which is robust to that. One element of that transition, a critical part of that transition, is the movement to a lower carbon energy system. We understand that, but we're not on a pathway anywhere close to achieving that at the moment. But it's only one element of the energy transition. The other part of the energy transition is the nature of energy demand is shifting as some of the poorest parts of the world, billions of people start to enjoy just a tiny fraction of the comforts that we all take for granted, and the world needs to provide more energy as well as less carbon if we're going to have a sort of sustainable, viable path going forward. Let me stop there. Thank you.
Thank you very much, Spencer, for that excellent presentation. I know that some of you in the back left from my vantage point of the room won't be able to see me as a matter of the obstruction from the pillar, so you're better off back there. But we will now have a bit of a panel discussion involving Shayle Kann and Katherine Spector and Spencer Dale. And then we will move to question and answer from the audience as well. I should have noted at the outset, but I'll try to make up for lost time and stress, that our program today is on the record. It is being live streamed in addition to being available to those of you here in the hall. Let me remind all of you, audience members, those here in person and those watching on the live stream, that you may submit questions at any time using the hashtag CGEP events and our Twitter handle, which is @ColumbiaUEnergy. Again, you may submit questions at any time using the hashtag CGEP events and our Twitter handle, which is @ColumbiaUEnergy. So, Spencer, let me start off, if I might, by asking what is admittedly a pretty much 35,000-foot question, and then I'll ask our colleagues also to join into the discussion. You've described a dual challenge, and a dual challenge that centers around the desire of people in the OECD countries wishing to ensure their energy security going into the future, the very important desire, in fact, I would say the moral imperative, that people in the developing world have energy for that development and for better social welfare, and at the same time, the other side of the coin being the climate challenge, which we're nowhere near being on track to meet adequately. Should we be encouraged, looking at the scenarios that your team has analyzed, should we be encouraged that we can meet that dual challenge, or should we be pessimistic?
I think we need to be realistic about the difficulty in meeting that challenge. So that rapid transition scenario gave a world where energy demand was rising. It was in a world where that would be more like 2/3 of the world's population still living in that low energy region, so still more to go, but also carbon emissions would only have fallen by about a half. So in some sense, you're taking a step on both, you need to go further beyond that. And so that's a plausible scenario. I don't think you need some tremendous technological breakthrough to achieve that. I think we know how to decarbonize the power sector. We know how to grow renewables. We know that there's a technology exists in terms of carbon capture, use and storage, which can be used together with gas and coal to provide another form of low carbon energy into the power sector. So we can achieve these things. We can achieve improvements in energy efficiency. But the reason why we should be, I think, cautious about that one is the pace of that change would be unprecedented. That was one of the messages from here. And so it's not like business as usual. And the second one is, don't sit back and think, oh, just technology will do this for us. It won't do it for us. We will need government policies, hard government policies to transform and make this change. And I think if sort of a message from here is, please don't rely on technology to solve this problem for you. One of my sort of key facts I like, just to sort of, it is true, which is even better as fact, is that there's been enormous progress in renewable energy over the last 20 years. It's amazing. And so that's just revolutionized in the world, surely. Yes, but the share of coal in the global power system in 2017 was 38%. The share of coal in the global power sector 20 years earlier, in 1998, was 38%. Okay? We've made no progress despite huge technological gains. We can't sit back and say technology is going to do this for us. Part of it is we all can make a difference in terms of energy efficiency, but it will need significant government policies, and that's a challenge. And some of the issues that are playing out in France at the moment underline the nature of that challenge. So I think not pessimistic, but we have to be realistic about the scale of the challenge we face here.
I want to also, and by the way, we're enriched by having two really great experts with their own perspectives on this, and I encourage you guys to please jump into this back and forth in a very lively way. But let me just ask one other question, which goes to the nature of the exercise of generating this annual outlook. You are at pains in the opening pages of the outlook to stress that this is not an exercise in prediction, but is rather an exercise in examining alternative possible variants of what the future could look like. But as I looked back over the press coverage that came out since the launch on Valentine's Day, almost to absolutely every last story, the first line is, BP sees the future looking like this. So why is it that that difference between scenario and prediction or projection is hard for us to understand? And how, as interested lay people, how should we think properly about the value of a scenario approach?
So I was, you mentioned at the beginning, I spent 25 years of my life working in central bank, particularly at the Bank of England, and under that I spent most of that time working for who then subsequently became the governor of the Bank of England, Mervyn King, and Mervyn had this very powerful thing that forecasts are a probability distribution. So for those who understand statistics, you should just think of yourself as trying to create, and you're trying to produce the probability distribution of the world, and we should then think about reacting to that probability distribution of the world. I think that's a correct way of thinking about the world, but it's very hard for many people to think about probabilities. I think it was true to say for a long period in the UK, weather forecasts on TV couldn't give probabilities of rain. They would say whether it's going to rain or not. And it wasn't thought helpful to say there's a 40% chance of rain because people want to know whether it's going to rain or not. But weather forecasting can't tell you whether it's going to rain or not. It will tell you a probability. Now, and the world just finding narratives about probabilities is a very hard thing to do. And so even within the company, I get people saying, but what do you believe, Spence? We need to put something into our business planning decisions. Which scenario should we use? And I say, I don't want you to use any single scenario. I want you to use a range of those scenarios. We want simplicity in terms of the narratives we tell and the assumptions we use. But when you're doing forecasts, the world is a probabilistic statement. And that's a hard thing. I understand it's a hard thing. And I think you just, as a communicator, you try and keep on making that, but ultimately you're going to have to sometimes just shrug and say, well, people will want it to take a more simplistic thing than the story I'm really trying to tell.
Well, but last question, then please, Shayle and Katherine, jump in. I mean, then you spoke earlier about the ways in which BP employs this analysis internally. Are you watching, are BP executives watching to diagnose that it looks like we're tracking rather more in this direction than in another one?
I wish we were that sophisticated. I think over time we can start becoming more sophisticated. I think we will update our sort of priors, for those who are thinking a Bayesian way, you'll update your thing. But then I think it's sort of, I made this point at dinner last night. When we're doing this type of analysis, I think of this as akin to your children taking a crayon and doing a fat crayon drawing. Okay, this is not
directly
fine art.
On the wall, right?
This is not fine art. This is trying to get the broad direction of analysis. And so the piece of work I was going to show you a whole range of different oil scenarios. Some of those oil scenarios had oil demand at 130 million barrels a day at 2040, and it went down to 80 million barrels a day. And there was a whole range in the middle of those. At the moment, I don't think I can tell the difference between, I think 130 is quite unlikely, but somewhere between sort of 110 to 80. And I would say to executives, it's somewhere in there, and I'm not sure it's worth spending too much time wondering about where in there it will be. The point I would also go on to say that if we stopped investing actively in oil, the world stopped investing in oil, the amount of oil supplies in 2040 would be about 35. Okay? So it's somewhere, oil demand, somewhere 80 to 120. If we don't invest in oil, 35. And so for us at the moment, I don't need to track exactly where between 80. I know that the world would need trillions of dollars of investment in oil to take it from that 35 just to the bottom one, that 80. That 81 was the profile for oil demand consistent with renewable energy off the charts. Okay? I think it's unlikely for it to go much more off the charts than that was. And so for us, the way we do our strategy is we'll carry on investing in oil, as long as that oil could well become more competitive over time, particularly if oil demand falls by 20% from 100 today to 80. So let's make sure it's low-cost competitive oil. And I think that's enough for our oil strategy in my big fat pen. And doing the sort of fine art, I think I'll leave for a level, it's a far more level of sophistication than I think, truthfully, we can do at the moment.
All right, I want to come back to oil and drill down on that topic, pardon me, in a minute, but just one more thought. Shayle, your work with Energy Impact Partners and your work before that with Green Tech Media obviously is focused on a very different part of the energy economy than where BP's traditional business has predominantly been. I wonder how you think about this question of the value and the complications around scenario analysis.
Yeah, it's a good question. So I focus mostly on the power sector, so maybe I'll spend my most time there. I spend a lot of time thinking about this quote that Bill Gates put in his memoir in 1994, which was, "We always overestimate the change we'll see in the next 2 years and underestimate the change we'll see in the next 10. And I believe that generally to be true. In this case, we're talking about a forecast out to 2040, so we're talking about longer than 10 years. And I think that it's a really salient question in the power sector, because if you look back over the past 5 or 10 years, we collectively, and this is true of BP, have generally been wrong in our forecasts, I think. And I will say, as somebody who used to do these forecasts for a living, the absolute worst thing that you could do to me on stage would be to show me one of my old forecasts and compare it. So I hope you'll forgive me, but I did look back at BP's energy outlook from 5 years ago, at which point the prediction for 2035 for renewable energy's share in the power sector was about 16%, and it's about double that today in the evolving transition scenario, so what you might consider to be the base case. So, and that's broadly consistent, right? Every major forecast has trended in the same direction, which was under prediction of renewables growth, and then steadily but incrementally increasing the forecasts for the same year. So if over the course of the past 5 years, we just keep increasing our forecast for where renewables are going to be as a share of the power sector in 2035 or in 2040, I guess my question is, what is to lend us any degree of confidence that that won't just keep happening, that we're not still under-predicting? Understand that it's off the charts, historically speaking, but we're in a different economy. Things can happen faster with globalization, and renewables are a different resource from these other resources.
It's a great question, and I don't mind showing those charts. You can look back in the last, at the back of the book, we have our comparison section, which says where we've been most surprised. In the past, I've shown charts where we've been repeatedly surprised on renewables. We've also been repeatedly surprised on US tight oil. I'm not embarrassed the least by that. The point of this is they're not predictions. We're trying to understand the future, and if the future's evolving in a different way, that's fine. We'll just learn by it. And if we systematically make the same error, at some point somebody will say, can I get somebody else to do this job for me? But we have to think about it. So renewables is an absolutely key point. We, along with many other people, have been systematically surprised. The question that you then ask is, how can we be confident that we won't keep on making that error? So the question is why have we been surprised? Okay, so one reason why we could have been surprised, and I think it's an element of it, is the pace of technology has kept on moving more quickly than we expected. So for a given level of solar capacity, that pace of improvement has just improved. So there's a so-called learning curve for solar energy, which is every time solar capacity installed doubles, the cost of producing that solar PV panel falls by 18–20%, some sort of number like that. Perhaps that learning curve has systematically been shifting over time because technology has been evolving. If that, far more quickly than we would expect it, just basis of learning by doing. If that was the case, we should build that in. It turns out that it explains some of it, but the vast majority of this isn't that the learning curve has been shifting, it's the pace at which we've been moving down that learning curve has just been faster. So it's the adoption which has caused us by surprise. What's the big driver of that adoption? It's China. So the pace, it's not the sole answer, but if you wanted your biggest category error, it's the pace of energy transition in China has been the biggest surprise. And so what that has done is the pace at which they've moved away from coal and adopted renewables has been a massive surprise. So the source of error here isn't there's something intrinsic about renewables, it's that pace of change in China. So one of the things I've got to make a sort of guess on to avoid making the same error again is not renewables per se, but the pace of energy transition in China. Now, I may get that wrong as well, but at least by the way we can sort of hope to try to avoid making the same mistake again, or being surprised again, is by understanding what the underlying source of the surprise has been, and then making a judgment about what lessons I should take from that going forward.
Now, just to prod on that, I guess, for one moment, I think it'd be hard to imagine China going through that same surprise again, perhaps, and that might make you a bit more confident, but I wonder about the rest of the world. India, for example, going to be a major source of that growth in energy demand that you described, has set out already extremely ambitious targets for solar penetration in the country. They may or may not hit that, but I wonder how you think about, if you're trying to learn from the China example historically to predict toward the future, do you think that something like that is unlikely to happen again?
So the path that India's taken, in one level, looks very similar to China because it's rapid growth. I think my hunch is, and certainly the way we model it, the willingness of India to provide enormous subsidies for several decades to support that growth, I think is less likely than we saw in China. So I think the growth we expect to see in India will be different by its type, because I think the degree of public support will be significantly less. So then there becomes a judgment call about how quickly can that renewable energy grow without the same level of public support that you saw in China. So although similar in one respect, they're the underlying drivers, I think, are somewhat different. And then we have to make a judgment call about the sort of amazing level cost auctions we've seen for solar power in India. Are they persistent? Are they sustainable? Will I see them? Will some of those end up looking perhaps a little bit too low, and there will be a sort of step back before we step forward? And that's a judgment call we sort of have to make in that space.
Catherine, you've made the comment when we were preparing for this that the energy system is such that you pull on one part of it and there are reactions in other parts of it. So I wonder if you could take us to the oil part of the discussion and your impressions and questions for Spencer there.
Yeah, and there were a lot of interesting components of the oil section, and I think we should sort of get into the weeds there. But just on the previous topic, one thing that was striking to me, Spencer, when you showed that chart, and I love a clever chart, so I really like the one where the energy sources start at the point where they break 1% and go for 50 years. One thing that you mentioned was that the reason that energy transitions are traditionally so slow is because these are long-term investment decisions, and you don't just change your mind about a power plant or something like that. And I think nuclear is probably the poster child for that. These are very long-term decisions that you don't just change your mind about. And it was striking to me that that is probably one thing that is different about renewables, and Shayle probably can speak to this as well, but we're going from an energy system where you had very high upfront costs and then low sort of future operating costs to potentially a system where you have much lower upfront fixed costs and higher long-term operating costs. And I'm wondering if the policy goal is to promote renewables, what sort of economic ecosystem or economic policies foster or support that sort of different structure of investment, and then how are the sort of existing energy giants thinking about this sort of shift in the economic architecture, if you will?
So, I mean, 2 points. One is, I mean, Shayle should correct me, but I guess my view of renewables is slightly different to yours. It's a massively capital-intensive investment because it's all upfront capital intensity with almost zero running cost. And so you can do it in a modular sense, but ultimately, for it to penetrate the energy system, you need lots and lots and lots of those modules. And so ultimately, this is highly capital intensive. It's a highly capital intensive, low operating cost business in terms, particularly solar, but I think wind as well to a large extent. And so you need to think about that. But the nature of the business, our experience in BP, we've had an onshore wind business for a long time. Over the last couple of years, we've partnered with Lightsource UK, or Lightsource, which was the largest European solar developer. It's now Lightsource BP in terms of doing solar development. But the nature of that business is quite different. So if you're doing a conventional oil and gas project, you own that, you make that fixed investment, and you hold that fixed investment as an equity stake for the next 20 years. That's how it works. the sort of business model that most solar developers are using. Shayle, Shayle will now correct me when I'm finished this, and he knows this far better than I, but my sort of idiot's approach to this, thinking about this, is most solar developers will take the development risk. They will think about that they will produce the solar farm. They will then try and establish a purchasing power agreement with a government or a very large gilt-edge blue chip company. That then looks like a securitized asset to a very large extent. And at that point, they sell it down and buy it and sell it to an investment pension fund or an asset management company that were more than happy to hold a long-term investment yielding a single-digit return. But you've made, because you've taken that development risk, you've taken that, you've got a sort of far bigger return, you farm down that and then you recycle that capital elsewhere. So it's a sort of very different model. And I think as companies like BP shift our bases away from being predominantly oil and gas and more to a sort of more balanced energy company, the nature of our financial framework underpinning that will also evolve over time as well. But Shayle knows far more about it.
So I'm going to actually preempt that, if you don't mind, just and say that in one moment or two, I'm going to open up for questions from the audience. My requirement to you, which I'll try to say as kindly as I can, is please identify yourself by your affiliation, form a question, and let's try to do this as quickly as possible. I'll take a couple at a time so that we keep moving along and take greatest advantage of Spencer's time. Let's take just a second on the oil side of the equation, because I think we would be incomplete if we failed to do so. So Katherine, if you don't mind, let me pass back to you.
Sure. Well, so two things that really stood out to me in the outlook were your supply side outlook, which was very heavily in the liquid space, light end material, NGLs, biofuels, and even within the crude segment, at least in the first part of the outlook, very heavily light end crudes from the US. So that's a lot of very light end material. On the other hand, on the demand side, your forecast, as well as pretty much every other forecast out there, puts a lot of weight in the petrochemicals sector that is meant to absorb quite a lot of naphtha in particular, as well as some of the NGLs. So it's striking to me, and this sort of comes back to the levers comment that John made. If you were to pull one of those levers, then it would have quite a big impact on the other. So in other words, if that petrochemical demand were to not show up, and that is one of the scenarios that you presented, what if our single-use plastics policies really do start to have a tremendous impact on that demand, and it's not insignificant in your view. Granted, it's not your base case scenario, but as a scenario, it is not insignificant. What happens to all that light end material? And it feels like we're getting a little bit of a preview at the moment. We've had some very weak gasoline demand, weak naphtha demand, and at the same time, quite a lot of light end material out there, certainly coming from the US to start with. And as a result, we're seeing widening light-heavy differentials in crude, widening product spreads. So it feels like a little bit of sort of foreshadowing. And what here could break, so to speak, and how would the complex as a whole manage a sort of a more extreme version of what we're seeing now?
Yeah, so on that second point, so very crudely, another pun, oil demand grows roughly, and liquids grows by about 10 million barrels a day, but only 3 of that is from crude and condensates, and the rest is coming from NGLs and other liquids. And so, first of all, this is a fairly challenging outlook for refining, because you pretty much have enough spare capacity for refining to meet that already built into plans already. If you see a world where, which we've seen in the past, countries like China and India wish to be self-sufficient in refining, so they keep on building up new refining capacity to meet that, then you're going to have a very significant surplus of refining capacity in other parts of the world. So this is a challenging environment there. I think another point which relates to this is the sort of the refining slate, which is implied by these products demand, looks pretty different to the refining slate of refineries today. So how do we think about that, which is sort of your question? At this point, I start to get out of my depth. I happily have a refining expert on my team, and their instinct is if this happens over a 20-year period, that's plenty enough time for refineries to shift their refining patterns. So I think, yes, if we pull one of those levers, the implications for the refining system would be different. But if that lever is pulled slowly over a 20-year thing, I don't think it necessarily needs to lead to a big dislocation. What we see in reality is when things happen over a 1 or 2 year period, then those things can have a bigger impact. And in some sense, we can get into it if we want, but the changes in terms of the IMO MARPOL regulations is a sort of good example of that, where it's sort of not immediately, but it's not over a 20-year period. We've had like a 3-year lead in, and still there are many experts in the world which are having different views of just how much dislocation we've seen. And
for
how
people in the audience who don't know, give it a thimbleful on IMO MARPOL.
Oh, you'll be better at this than I do. You can do a better one than this.
There is a shift coming up in the required fuel for shippers to use that will essentially move from a heavy residual fuel oil to a diesel. And that will be a big enough segment of fuel oil demand that there will be really very little left. That's the bulk of what fuel oil is still used for. And at the same time, a big increase in diesel demand if things go the way that they've been laid out.
And there's a range of views. Some experts think this could lead to a very significant blowout of those middle distillates because they're just the increasing demand. Others are more sanguine and think that the flexibility of the refining system to adapt to this will mean that it will respond and the impact on differentials are less pronounced. The reasonable people can disagree here, and in some sense we're going to see this takes effect in 2020, so we're living through a live experiment in some sense.
So now we'll open up for questions. Let me remind those of you both here in the audience and elsewhere at your desks at home that you may pose questions using the hashtag CGEP events and our Twitter handle @ColumbiaUEnergy. I see a question here in the very front. Please state your name, your affiliation, and your question. Oh, okay.
Thank you.
Go ahead.
Energy Mentors International.
Microphone. Go ahead. Keep going.
My question is specifically on carbon pricing. And what I'd like to hear is how BP has hopefully taken that into account in one of the scenarios, and specifically concerning a level of carbon price. Most people nowadays talk about to have an effective impact on carbon emissions, especially on power generation, you need something around $50 per ton, plus or minus.
Thank you.
Could you please
We're
comment?
going to take the next question here in the front, the lady with her hand up, please.
Hi, my name is Diana Glassman. I'm a strategy consultant, and I work in the area of ESG and oil and gas. My question is, you mentioned, Spencer, the other surprise, I believe, was tight oil and gas, which I assume to be shale in the U.S. What percentage of production in the U.S. comes from non-majors? I've asked this question of a lot of people. No one seems to know the answer. And if EDF, Environmental Defense Fund, has set a target of 0.2% methane, what percentage of the methane do that non-transparent part of that oil and gas shale onshore U.S. is accounted for?
And maybe you'll say just a word there about the methane pledge as well. So let's just take those two, and then I'll be scanning the audience for others that want to pose questions. Do you want to kick off there?
Yes, let me try to be brief. In terms of carbon pricing, carbon prices in the evolving transition scenario in the OECD, roughly about $40 a ton in real terms. It varies across countries, but roughly. The answer to that is that's not enough. Carbon emissions are still rising. In the evolving transition scenario, they reach $200 per ton in the OECD and $100 a ton in the non-OECD. 2 points from that. One is they only get there very gradually. I mean, we get them getting there gradually because if they get there too quickly, you then scrap productive assets, which is a costly thing to do. So that raises then two questions. What do we ask politicians today to do on carbon pricing? when what we want them to do is very gradually over 20 years. My own country in the UK at the moment is going through a series of votes on Brexit. It's very hard for the Prime Minister to commit to a vote within a week time. So how can we ask politicians to commit to something 20 years out? So that's one issue. The second issue is if we are raising carbon prices only slowly, economists like carbon pricing, it's lovely, it's the way to deal with this, right? But if you're dealing with them, you're only raising carbon prices only gradually, that means for a period of time they're not having much bite. And so you may need other types of policies to provide a bite in the near term until carbon prices are raised up. So in our analysis, we have a role for targeted regulatory policies. And the design of that regulatory policy is to try to provide incentives for forward investment without affecting the impact to use existing assets. So how can I affect investment going forward without scrapping assets?
Let me just pull one more thing out of you on this. You've stressed the desire to avoid scrapping existing assets. For a person who is worried, as many people are and should be, about our response to climate change, why is that a suboptimal thing to do?
Well, I think if you do that, that is obviously costly. It's increasing the dead weight. At least there's adding a significant cost component to that process because you're scrapping productive things. If you like, not if you like, I think as a reality, the nature of that blue swathe I showed you in terms of why some people were a lot slower and some people were going down quickly was a judgment call about the sort of how much should I bear cost today by scrapping assets to bring them down very rapidly. And that was ones who were very sharp. Others, towards that top end of the range, make the judgment call, actually, you can do a lot more of this beyond 2040 at a more cost-efficient way of doing it. And therefore, why bear lots of costs now if you can do more of it by providing the right signals further out? And I think that becomes ultimately, it's a judgment call about economic costs, it's a judgment call about technology costs, it's also a judgment call for politicians to weigh up the certainty of cost today versus the possibility of the future, and that's a political choice variable. Just on methane, Diana, the truth, I don't know, I'm not sure if you know, Katherine, in terms of my hunch would be really quite significant is in small E&P producers. And I did some different analysis recently, which was looking at, my instinct had been that the investment would be in the lower 48 would have become increasingly concentrated because more and more the majors are moving in. And up until I think my data ran out was a year or two ago, you still hadn't seen, I looked at what proportion of total investment going into shale was provided by the top 10 companies. And I thought that would be getting bigger and bigger as shale became more like conventional. Remarkably, it didn't show any sign of that. So this is still different. And so those small E&P producers, I think, are still major. What proportion of methane or methane that they account for, I don't know. I guess all I can say in terms of methane, I think BP are very aware that we're very clear that natural gas can play a role as a transition fuel and potentially destination fuel. In terms of a low carbon energy system. But to do that, we need to make progress in terms of methane emissions. And we are very committed both as a company, we set our own targets, but also working with the industry as part of the Oil and Gas Climate Initiative to make progress in terms of this. And we need to get better at greater transparency of methane emissions and also greater transparency of what we're doing to reduce and control and manage those methane emissions over time. So we are very aware of this and very committed to playing our part in this because my own personal view is it is critical for natural gas to play the role it should and can and needs to play as a transition fuel. We need to deal with this head on.
While you're taking this question, I just wanted to jump back for 1 second to the scrapping productive assets conversation. I think it adds, correct me if I'm wrong, adds cost to the overall system only to the extent that it's not more cost effective to scrap a productive asset and replace it with something that is cheaper than the operating costs of the productive asset. And the example I would give is we're just starting to see glimmers of this happening in the power sector in the US today, wherein there have been a few utilities recently in Colorado and some other places who've done the calculations and said it's actually going to be cheaper for us to procure new wind and solar than to operate a coal plant that is continuing to operate. So we'll scrap it early retirement, replace it with other resources that just come in at a lower cost.
Absolutely, and so 100% agree. And the only point here is that judgment call about if it's economic to scrap it today is endogenous to the carbon price. So a carbon price of $20, some things would be scrapped and others wouldn't. A carbon price of $200, a whole range of other things. So at that point, you're making a pure economic decision. It's now economic to scrap this, but you are scrapping an awful lot of assets at $200 a tonne. If we just ramped up to $200 a tonne now, then a lot of things would be no longer economic, but they would be productive. And so, so that the decision is in itself endogenous to the environment and the regulation which is there, which is sort of affecting that system or managing that system.
So a question here in the second row, please.
Hi, my name is Stephanie Ma. I'm from Xinhua News Agency, and I have 2 questions. And the first one is that...
Let's just do one, please, and then we'll move on to somebody else.
Oh, okay. It's said that China will make more purchases of American agriculture and energy products like liquid natural gas after the latest round of trade negotiations. So how do you expect that and also the trade tensions between the 2 countries will influence the current global energy market? And also, just one follow-up question is that you mentioned about China's input of natural gas will be lower by 20% in 2040, and China will move more to domestically produced new energy and also coal in your second scenario projection. So would you please elaborate more on that? Thank you so much.
I'm not very good at math, but I thought that was 2 questions. I think there was somebody else had their hand up. I'm sorry, in the front row here. And then I see you here.
Thank you, Henrik Evertsen from Carbon Tracker Initiative. Just a quick question. The key underlying assumption behind all of these scenarios you've done here is the same GDP outlook. But you have also seen that on one of the graphs here that GDP growth and etc. is what really the key driver for why energy demand is going to be larger in the future. How much sensitivity analysis have you put into this? Because it seems a very convenient way to say, well, things are going to be this way because growth, from a GDP point of view, is going to be a certain level. So how much sensitivity analysis have you done? And could you share some thoughts on that?
Thank you. And why don't we take that as a gentleman here in the back that's been very patient, and then Shayle, I know you had a question as well. So we'll take those 2 in the next round, please.
Okay, so briefly, on China, one of the joys of doing a 20-year ahead outlook is I don't need to worry about the near term. And so I don't have to have a view about US-China trade issues, and as a UK person, I definitely don't want to have a view about China, US. The point about that trade dispute in terms of the broader point, that if we're in a world where China increasingly worries about energy security, I think a natural instinct, if I'm worried about the security of the imported energy, will be to try to find a way of substituting away from imported energy towards domestically produced energy. I think that's just a natural, logical consequence. What China can produce domestically is renewable energy, it's nuclear energy, and it's coal, and to an extent natural gas as well, if they can push hard on some of that natural gas. And so I think that's just a natural process, and this was just a calibration of just how big those numbers could be. In terms of GDP, yes, so the underlying growth of energy demand is economic growth. That economic growth, 80% of that is coming from the developing world, driven by increasing prosperity. If we see that increasing prosperity not coming through, so there are many experts that talk about the middle income trap, and if that middle income trap kicks in, then you will see less economic growth, and that will feed through into energy demand. It will obviously feed through to everything in the whole world, and so these aren't energy issues at that point, they're far more fundamental. The one point that we see here is improvements in energy efficiency, at least in the literature, both empirically and for good economic reasons, are correlated with improvements in economic growth. So energy efficiency tends to be correlated. So that's one scenario I showed you was a hit to economic growth of 6%, but energy demand only fell by 4%. because essentially you just had less economic efficiency as well. So it will feed through. In a scenario 2 or 3 years ago, we said, let's suppose China's economic growth is just surprises to the downside. Let's see how that plays out. So we did it in that thing. So you're absolutely right. And I think the, no, let me stop there, or I'll take too long. Yes, stop.
Okay. So just here, thank you.
Thank you. Michael Hertz, Vicus Partners. I was curious, as I looked at your chart there, you really didn't show much growth in terms of biomass. And I was wondering if you could comment on the use of biomass as transitional fuel for offsetting coal, which has been done by Drax and several other people.
Great. And while you're moving the microphone to this gentleman here with the glasses, I'm going to ask Shayle to pose that question that you had before on EV.
Thank you for the presentation. My name is Pepe Banda with Energy Transition New York. I wonder if it is possible to capture in this document, very important for energy in the world, that what the top 10 or the most important energy companies are doing in transitioning towards the Paris Road in terms of investments. So are they investing more in research and development in renewables, for example, lobbying for renewables, policy on renewables, something like those?
Okay. And you get to it? Okay, all right. Go ahead, please.
In terms of biomass, what we are, in some sense, so in this energy outlook, or in our energy outlook, we only look at traded biomass. And so the IEA has estimates of non-traded biomass, which is a very significant component. We only look, in some sense, this is a traded energy outlook. So we're only looking at of traded biomass. We have some growth, but it is small over the next 20 years. And it may be that we're not thinking about this deeply enough, but in some sense, we're not getting the right price incentives to generate a very significant increase in traded biomass. Drax has obviously is a great example of a company that has done that, but we're not around the world seeing enough price incentives in that evolving transition scenario to really get a significant kick going forward. In terms of Paris investments, I think, in some sense, the whole theme of the outlook was thinking about this transition to a lower carbon energy system and the role we should play. I guess 2 messages from there is by far and away the quickest growing source of energy is renewable energy. We're a business. If something's going to grow very rapidly, of course you want to be part of that, and so you've looked for business strategies which you can do that. I talked about Lightsource UK and Lightsource BP. We also have a bioenergy business in Brazil. We have a wind farm business in onshore here in the US. So you want to play in those spaces. But one of the other messages from this is, even in a consistent Paris consistent goal scenario consistent with Paris, we will need many energies for many years. Oil and gas in that rapid transition scenario with renewables growing off the chart is providing 50% of world energy. For oil and gas to provide 50% of world energy in 2040, you will need trillions of dollars of investment in oil and gas. And so we should carry on investing in oil and gas. And when we do that, we should be doing that in the most efficient, sustainable way, trying to reduce our carbon footprint. Our commitment in terms of methane emissions to limit methane emissions to 0.2% is our commitment. And I think that led the way for industry, for many industries to do it. We are also trying to make similar improvements in terms of our footprint in oil. So we are likely to have, the world would need many energies for many years. And as a company like BP, we hope to provide some of or most of those many energies for many years to come.
I'm going to take the moderator's prerogative and pose one question and then come to Shayle and Katherine for parting shots before a last word to you, Spencer.
You always worry about parting shots, don't you?
You made a very interesting point about the dangers of groupthink and alluded to your time in the central banking world. In the energy world, what kind of risks do you think can arise from groupthink? What are the types of traps you and your team are trying not to fall into?
Well, any sort of assertion, if you got 10 energy economists and 8 or 9 people are nodding at that, you should worry about it and try and challenge. So the GDP challenge is a good one. I think most major energy companies tell a story where natural gas continues to grow quite robustly over the next 20 years. That's perfect to try and find out why that's wrong. So we've had a real go the last 2 or 3 times, because remember, we're investing on the basis of this. There's no point in selling us, wow, there's a great story for natural gas, if you think actually there's a vulnerability there. So anything where you find everybody agreeing is where I think you should try and find, pick holes in it. So this time last year, in our last energy outlook, we said to a story, very rough numbers, just to give you a metric, we had gas growing by about 1.6% a year on average. And then we said some of that is coming via environmental policies where people are encouraged being switched away from coal into natural gas. Let's just suppose none of those happen. Let's suppose the world just goes cold on those environmental policies. So what would happen if we just had no coal to gas switching? And very roughly, it took about a third off of growth. So rather than growing at 1.5% or so, it grew by 1%. Now, that's compared to coal of 0 and oil of 0.3, 0.4. So it's still strong, but it's taking a third off. And then we said, suppose you had really aggressive carbon actions, and then that also reduced the demand for gas. You still saw it growing, but less so. And so in some sense, there was this sort of sweet spot that you wanted, in the UK we have Goldilocks, not too hot, not too cold, in terms of your porridge. And it was sort of like that. Too cold environmental policy harmed natural gas demand because you didn't see the switch away from coal into natural gas. Too hot, and you could see it being squeezed out by renewables. And in the middle, where we sort of were, was helping the best. But then you're sort of saying, what's the scale of those things? So that's one example where we try to go after it. I think we keep on challenging ourselves on oil demand and trying to think about where we could go wrong. This time we said, suppose there's an entire worldwide ban on single-use plastic. So I think anything where you see people agreeing, worry about it and try and challenge and find out why it may be wrong. That's got to be the rational thing to do. And for my role, it generates far more interesting conversations than just keep on writing things which conform to the received wisdom.
Catherine, please, parting shots.
Well, it's not a shot, but on that similar note, I think in addition to when you see a lot of agreement, when forecasts are sort of straight line trends, that's also not necessarily particularly informative. And I think that, we all know that in any forecast, there's a lot of bias to what we already know or what we've already seen. And I think, and maybe people whose job it is to make forecasts just say this to make themselves feel better when they're wrong. But I think a more useful version of a forecast is sort of outlier scenarios. What could really be different? Because anyone from the oil world knows that most of our sea changes in this market have been from big, acute paradigm shifts, whether it was the oil embargo or the shale revolution, things that would not come into a straight line, sort of linear type of forecast, certainly. And there's really no value in a forecast being a parlor trick, sort of picking the right number. It's really in sort of explaining what could be significantly different than what we expect right now, and how would that make things look. And I think, to me, that's the value in an outlook like BP's. I'm not necessarily interested in their parlor trick number more than anyone else's. I'm interested in, well, what could really be significantly different here? And things like, well, what if single-use plastic demand did go to 0? Or what if trade, the philosophy on trade and whether it's good or bad really changed significantly over a long period of time? That's what makes a report like this interesting.
Parting observations, not shots. Shayle?
I'll take a friendly shot. So I'll offer maybe a mirror image to my original comment about the pace of change on renewables onto another sector that we haven't had time to talk about now, but I think is important and where there's big uncertainty in the forecast, which is vehicle electrification. It's another similar place wherein every single year the forecasts all trend in the same direction. They go up year over year. It has been true of BP's. BP's forecast for the global EV park, number of global electric vehicles in 2035 doubled from the 2017 outlook to the 2018 outlook. And I think part of what's happening in EVs, partially the same answer. China has been a surprise there too. In addition to that, I think it's become clear over the past few years that the auto OEMs are serious about this. And so we have a couple hundred new electric vehicle models hitting the market in the next 5 years. That's certainly contributed to forecasters sort of appreciating the pace that we will see adoption. My perspective on what we see there today in the forecast is you look out in sort of your current outlook and you get to a market where there's actually reasonably high penetration of new sales of light and medium duty vehicles that are electric by 2035 or 2040. Still very, very low penetration in the heavy duty shipping and aviation markets. What I see in my day-to-day as a venture investor is a whole wave of technological innovation occurring on heavy-duty EVs, for example, and we will see a wave of trucks that are electric coming in the next 5 or 10 years. So I worry that we have the exact same thing continuing to go on in the electric vehicle world, which is we're just not seeing quite around the corner to how much this will be available and all the benefits that it'll hold in the heavy-duty market just as much as it does in the light-duty market. And so in 5 years, are we going to come back, have this conversation, and the outlook for electric vehicles will have doubled again?
Well, one thing that's certain is that these are topics that will continue to be on our minds and very much front of mind for everybody, I think, in this room and elsewhere. Let me do a moment of public service announcement, if you will. All of our research products are available on our website at energypolicy.columbia.edu. I also call your attention to the fact that the Center on Global Energy Policy has its annual Energy Summit taking place in the middle of not next month, the month after that, April 10th. It's an all-day session that will involve a number of really excellent speakers from government, from private industry, from advocacy organizations. Just to give you a smattering of these people, Alicia Barton from NYSERDA, Neil Chatterjee, the chair of the Federal Energy Regulatory Commission, Xavier Chen from ENN Group in China, Carlos Curbelo, former congressman who's been advocating for a carbon tax, Fu Chengyu from China, former Sinopec and CNOOC chair, Alex Halliday from the Earth Institute, Vicki Hollub from Oxy, Governor Jay Inslee from Washington State, Kathy Zoy from EVgo. That's just a sampling of the people who will be with us for our Energy Summit on April 10th. I'd like to end by thanking Spencer Dale and his team for this outlook, and particularly for your personally and your team's interest to engage in conversations where there's an element of challenge and really kind of everybody looking under the hood together. In doing that, I think it's a great service, so thank you very much for being here today. Thank you also to Katherine and Shayle. Ladies and gentlemen, thank you for coming.